So we decided today to lower interest rates from 0.5 to 0.25%. The reason is that we have a low inflation pressure in Switzerland, and also there are downside risks to inflation in Switzerland, and therefore we lowered the SNB policy rate today.
But it's quite interesting. The other central banks, many other central banks in the world, they're staying put. Why are you deciding to move ahead with the cut?
We do monetary policy for Switzerland, and we came to the conclusion that monetary conditions in Switzerland need this cut of 25 basis points to 25 basis points currently.
So you don't see any value in waiting to see how conditions will evolve?
So in monetary policy, if you see a need to act, you have to act early and decisively, and this is what the Swiss National Bank does. Because waiting does not add value. If you wait, then you have to react even more in the future.
Especially since you're only deciding on monetary policy every quarter, so that obviously separates you from other central banks. I want to talk to you about the likelihood of negative rates. This is something that the options market had priced in back in December for the end of this year. Now it's looking a little bit less likely. Is that still a tool that you're actively considering?
So in Switzerland, nobody likes negative interest rates. Also, the Swiss National Bank doesn't like negative interest rates. But I can assure you that we will not hesitate to use all the tools that we have in the toolbox to warrant price stability and to conduct our monetary policy.
Another very widely used tool by you in the past, of course, has been currency market intervention. Now, if we take a look at the data from 2024, it is almost ground to a halt. Are there political concerns about drawing the ire of Donald Trump if you return to this tool?
So we are ready to use all the tools that you have in the toolbox, be it on the interest rate side, but also on the exchange rate side. I can maybe also say that Switzerland is not a currency manipulator. When we used the FX interventions in the last decade, it was because inflation was clearly too low, so it was a tool to fulfill our mandate, which is price stability.